Ukraine, the pandemic, supply chain concerns. There are many things causing fluctuations in the market right now. But does our perception really match reality? Joining us this morning is Peter Stashecki from Everything Financial. Good morning, Peter. Good to see you.
Nice to see you, Carrie. Good morning.
It just seems like everything is fluctuating, as we mentioned. But how much are the markets really down right now?
Yeah, perception and reality, right? Well, the Canadian market, if you don't count the rally that's going on right now this morning, is only down from its peak about 2.7%. Now, by the end of today, if it stayed where it is right now, it'd be less than half of that. So that's not really down a lot. The U.S. market, a little under 10%, but with the rally today, that could be about 7.5 or 8. But when you hear the news, sorry guys, not to throw you under the bus, but when you hear it reported, people think it's down like 2008 type numbers or even the pandemic numbers of 36%, and it's not even close. It's just marginal. The thing is, it's up and down quite a bit, and that's where the volatility comes in. And the perception that it's just always down comes in.
Yeah, well, it seems like, with inflation at record highs and what we believe the markets to be fluctuating, should we ride it out, cash in and wait, or invest? And what do we do here?
Well, it's funny. I was asked the other day about, am I getting a lot of calls about people wanting to cash in or panicking for that matter? And I had probably 2 phone calls, that's it, in the last 6 weeks about people panicking. I had over 30 phone calls about people wanting to invest. So people are listening, they're learning that when the market is in a state of volatility, the one thing you do is you don't make that volatility or a down market on a down day a reality by cashing in. This is where you hold firm, and this is where portfolio managers really shine, because they're looking for the bargain basement discount deals, or what are the things we should be buying that are going to be on their way up, and you just sit and stick to your plan. And that's the key, is having a plan that's long term so that these fluctuations don't affect you, and you're not really down if you haven't sold. It's just the value today. That's all it is.
You just talk about the long-term plans, because a lot of people, if they have retirement in their future, they may be concerned about the fluctuations in the market. What can you do if you are retired and you need that income?
Yeah, that's the people this affects the most. And that's where you have to have what we call, really technical term, Carrie, Plan B. And Plan B, if you own your house, and that's where this comes in, you can have a home equity line of credit. We've talked about these before in these segments. Maybe you're not even using it. Maybe it's just sitting there for safety, but maybe for a couple months, you take your income from your home equity line of credit, because the interest rate on that will be very inexpensive. I mean, it's so low, and you wait for this volatility to pass, wait for your portfolio to recover, and then the normal income you would have taken out of your portfolio, you just take it then and pay back your home equity line of credit. Because for a couple of months, say you need $5,000 a month of income, the interest on that is really peanuts compared to making a loss a reality by cashing in some money. Do Plan B, and it'll help ride it out until we get some stability back in the market.
So the theme I'm getting here is that it's best to just sit tight and ride it out.
Sit tight, ride it out. And the first thing is, though, before that, get a plan and then stick to the plan.
All right. Peter Stashecki, a guy who can give us the plan, Everything Financial. Thank you so much, Peter. Enjoy your day. We'll talk to you next week.
Thanks, Carrie. Have a great day.
You too.